You spend weeks backtesting a new strategy. The data is clear, a solid 60% win rate. You go live, brimming with confidence, take a handful of trades, and watch your account vanish. It's a common trap. You spend all your time hunting for the perfect analytical edge, assuming that a high probability setup guarantees you will beat the market. But probability dictates otherwise. Even a professional strategy winning 60% of the time ensures you will lose 40% of your trades. Statistically, long losing streaks are a mathematical certainty. Executing a setup without structural risk controls leaves your capital exposed to the same mathematical variance found on a casino floor. Let's run a stress test to see exactly how quickly things fall apart. We'll take a normal 8-trade losing streak and apply it to a $10,000 account. Risking 5% per trade, 8 consecutive losses cause a rapid 40% drawdown. $4,000 gone. To recover from this crater, you need a massive 67% return just to reach the original $10,000 baseline. At this depth, logic disappears. You feel panicked, demoralized. You start doubling your lot sizes to win it back, taking irrational revenge trades right before your system's actual winning streak begins. That elevated stress state completely hijacks your discipline, causing you to abandon perfectly valid, highly profitable setups out of fear. The collapse of a perfectly valid technical strategy with no room to perform. Let's reset the parameters. We'll run the exact same stress test, but we'll replace that emotional sizing with the 1% rule, meaning we never risk more than 1% of total equity on a single setup. We feed the new chart the identical 8-trade losing streak. Capping a risk at 1% limits damage to a shallow descent, bottoming at an 8% drawdown. This preserves over 90% of your capital, leaving plenty of ammunition to execute your edge. This strict limit functions as a survival guarantee, keeping you in the market long enough for the law of large numbers to materialize into profit. Applying this protection requires stopping the habit of guessing your lot sizes and moving to a strict 3-step formula before every entry. First, calculate maximum dollar risk. A $10,000 account times 1% equals a $100 limit. Second, determine stop-loss distance based on technical invalidation, say 30 pips. Third, calculate position size. Divide the $100 limit by the pip value. For euro-dollar, that's 0.33 lots. A critical trap here is confusing a fixed monetary limit with a fixed number of pips. Using a generic 20-pip stop on a highly volatile pair like the British pound-yen is far more dangerous than using it on the stable Aussie-Swiss. Your stop distance will constantly change based on market structure. Adjusting your lot size to fit that structure is the only way to ensure your financial risk remains identical across completely different trade setups. Beyond the math, this rule operates as a heavy psychological firewall, severing the emotional connection between you and the chaos of the live market. When your maximum exposure is capped at 1%, a losing trade no longer triggers a fight or flight response in your brain. A $100 loss on a $10,000 account is simply recorded as a standard, unemotional business expense. As your equity fluctuates, the limit naturally adapts. If your account grows to $12,000, your risk bumps up to $120,000, compounding your gains. If you draw down to $9,000, your risk drops to $90,000, automatically hitting the brakes. Forcing every single trade through a non-negotiable filter strips away FOMO and guesswork, building unshakable long-term discipline. Professionals don't waste energy worrying about the outcome of any single setup. Like casino owners, they focus entirely on ensuring their mathematical edge plays out over hundreds or thousands of hands. You see this across every institutional trading floor in the world. They prioritize strict risk parameters over speculation. Managing risk is the entire game. You can build the most sophisticated algorithm on Earth, but without ironclad capital controls, the market will eventually break it. Stop guessing your position sizes, mandate the 1% rule in your daily trading plan, and use the risk management tools at FXNX to actively protect your capital.